Recording in progress.
Good day, everyone, and welcome you all to ICRA's webinar on Trends and Outlook Indian Auto Component Industry. Mr. Shamsher Diwan, Group Head Corporate Ratings, with his team will take you through the presentation. The presentation will be followed by a Q&A session with the participants. You can place your questions in the Q&A box. Over to you, Shamsher.
Thank you, Anshu. Good evening, everyone, and welcome to ICRA's conference on the auto component sector. The sector, along with the broader automobile industry, has witnessed its fair shares of challenges, from COVID-led disruption to supply chain issues, and now a very sharp inflation in commodity prices. The sector has seen it all over the past 18 to 24 months. During the current fiscal, however, we expect that the industry is likely to register a growth of about 13 to 15% in revenue terms, driven by domestic OE demand, replacement demand, as well as pickup in export segment. In addition, there will be pass-through of commodity prices, which will also support our revenue growth estimates. The healthy volume growth would, however, actually be coming on a very back of a very low base. During the course of the year, we had revised our estimates by approximately 200 basis points from our previous estimates, primarily because of two factors. One, the recovery challenges on account of the semiconductor issues, and secondly, a muted rural demand for two-wheelers as well as tractors. In terms of EBITDA margins as well, the sector is likely to see moderation with challenges in completing the cost of raw materials, logistics, and energy cost. All of this means weakening in the financial profile for the credit metrics continue to remain in a comfortable zone as per ICRA's estimates. At ICRA, we rate close to about 120 for component manufacturers. During the current fiscal, while there have been challenges for the sector, the number of upgrades have actually exceeded the number of downgrades. And these are primarily driven by equity infusion measures taken by certain companies to improve technology. Today is Mr. the promoter and the joint managing director of Super Auto Forge. Auto Forge is one of the exporters of auto from India and is engaged in manufacturing of cold forged steel aluminum components, domestic and export market, with focus on Europe. Our first session from Ohio State University and working in Detroit during the initial years, Mr. Ravi joined Super Auto Forge back in 1997 and has been instrumental in developing the company's business, especially in the US and the European markets. He currently serves in ACMA's regional committee and in the executive committee of the Madras Chamber of Commerce. He's also past chairman of the Indo-American Chamber of Commerce and has been part of its regional as well as national committees. On behalf of ICRA and the team, we welcome you, sir, and thank you for sparing out time today to be part of our webinar. I'll now request my colleague, Ms. Vinuta, to deliver the presentation before we start the Q&A with Mr. Ravi Shankar. Thank you.
Thank you, Shamsher. Good evening, everyone. This is the agenda for our presentation. We will begin our presentation with demand dynamics and then move on to issues that the industry is currently grappling with, such as the cost inflation and supply chain challenges, and how these translate into financial and credit rating movements. We also have a section on the advent of electric vehicles and what it means for auto companies. Okay. About 52% of the auto component demand was from the domestic OE segment in FY21. Another 19% came in from domestic replacement, while about 29% was from exports. In the domestic OE segment, PV demand recovery has been healthy, with preference for personal mobility. However, ongoing semiconductor chip shortage issues and commodity headwinds are playing spoilsport. We expect demand recovery in CV as well, with the goods carrier segment leading recovery in the MNHCV segment and e-commerce, last mile transport, etc., supporting demand in LCVs. However, the two-wheeler demand has been sluggish due to sustained increase in cost of ownership, fuel inflation, and supply chain issues. Higher base, last year and delayed harvesting in some parts of the country due to undistributed rainfall have led to moderation in tractor demand over the last few months. While we do not expect any major direct impact on the domestic auto sector due to the ongoing tensions in Russia and Ukraine, the impact would emanate from issues around the semiconductor chip production, as Russia and Ukraine are both suppliers of components used in semiconductor manufacturing. Ukraine is an important source and supplier of raw materials, such as semiconductor-grade neon used in manufacturing, and Russia is a key source of palladium, which is used in memory and sensor chips. Thus, a long drawn-out war could impact supply chain and constrain production levels across segments. This would remain a monitorable. This apart, the rising oil prices will be a key headwind, especially in the two-wheeler segment, which has been affected by rising cost of ownership. This slide talks about the domestic aftermarket demand, which along with exports insulates the downside during OE demand slowdowns for the auto component industry. The aftermarket industry witnessed healthy growth in volumes in YTD FY22, aided by improvement in personal mobility, healthy freight movement, and deferment of new vehicle purchases due to cost inflation. Part of the revenue growth has also come from commodity pass-through, with periodic price hikes in the last 1 year. While January 22 to mid-February 22 were relatively dull because of the Omicron wave, demand has picked up in the last few weeks. Q4 FY22 is likely to be flattish on YOY basis for aftermarkets because of the last high base of last year and the Omicron impact in the beginning of the quarter. Liquidity in aftermarkets is comfortable with improvement in inventory stocking as sales pick up. There were some issues in collection in January because of the Omicron-related absenteeism and quarantining and consequent inability to collect payments, but that has subsequently improved. Going forward, demand for public and private transports as schools and offices reopen and improvement in economic activity and freight movement is likely to aid replacement volumes in the next few months. In the long run, electrification, especially in LCVs and buses, including school buses, increasing life of components, and potential impact of scrappage policy and increasing consciousness towards emissions will have a bearing on aftermarket demand. Now, moving on to exports. Exports have been a bright spot in the Indian auto component story. Indian auto component suppliers have reported healthy improvement in export volumes to Europe in YTD FY22 and strong order book over the next few months, partly aided by the China Plus One strategy. ICRA believes that the order book for Indian auto component suppliers in the export markets would have been even better if not for the chip shortages and container issues. North American Class 8 truck OEMs witnessed strong order inflow in 11 months of FY22, supported by renewed confidence resulting in robust freight growth, fleet owners having sufficient cash, and pent-up demand, despite the supply chain issues and high commodity prices. While November 21 order inflow was weak, as OEMs remained reluctant to increase total backlogs because of the supply chain uncertainty, there was some improvement witnessed in December 21, January 22, and February 22. Overall, we see healthy traction across OE, aftermarket, and export segments in terms of volumes, albeit on a relatively low base. There has been some upside to revenues from commodity pass-through and forex movements. Going forward, premiumization of vehicles, focus on localization, and increasing content per vehicle will translate into relatively healthy growth for auto component suppliers over the medium term. Caveats on supply chain disruptions, sustenance of elevated commodity prices on demand remain for FY23. Now, moving on to commodity and other cost inflation. Major input raw materials such as steel, aluminum, and copper have witnessed significant price increases in FY22 and are ruling at multi-year highs currently. While commodity prices did see some marginal softening in the last few months, The ongoing Ukraine-Russia geopolitical tension could lead to supply shortages and increase in commodity prices. We expect commodity prices to remain high in the next few months. Crude-linked raw materials will also witness price increases. On specific commodities, around 45% of steel production is from Russia and about 75% from Ukraine are exported. This could lead to regional supply shortages and steel price increase as Russian mills brace for sanctions and Ukrainian steel production gets disrupted by the conflict. As far as aluminum is concerned, Russia contributes to almost 12% of the global trade in aluminum. Since aluminum already has a tight demand-supply balance and therefore low inventory levels worldwide, sanction imposed on Russian aluminum exports will aggravate the metal availability in the rest of the world, possibly keeping prices at a high level till normalcy is restored. With sharp increase in commodity prices in the last 3 to 4 quarters, auto ancillaries have not been able to pass through it entirely, resulting in decline in gross margins. The gross margins of auto ancillaries is expected to be lower on year-on-year basis in FY22. The increase in oil prices will also have a bearing on fuel costs for auto ancillaries in the coming months. Another important headwind that the industry has been facing is on the freight front. Container shortages have resulted in substantial increase in freight rates. Sea freight has increased by about 4 to 5 times in the last 1 year and is likely to remain at elevated levels in the next 3 to 4 months. Because of delays in shipments and raw material arrivals, we've seen several players use air freight as well. All of these put together have resulted in higher working capital requirements. We will discuss on the semiconductor shortage, which is the most talked about issue, in the next few slides. Stronger than expected demand recovery across industries, especially for computers and communication devices, along with supply disruption at a few chip manufacturing locations globally, aggravated chip shortage issues, as we all know. Usage of electronics in vehicles has been continuously increasing. Electronics make up about 40% of the content of today's average new automobile, and the share of the same is expected to continue to grow, thereby necessitating higher dependence on semiconductors. This slide talks about the region-wise dynamics within semiconductors. Nearly 75% of semiconductor manufacturing capacity, as well as many suppliers of key raw materials, such as silicon wafers, photoresist, and other specialty chemicals, are concentrated in China and Eastern Asia. US-based semiconductor firms remain the leading consumers at the global as well as regional level, with market shares ranging from 40 to 50%. Let's now look at the automotive supply chain for semiconductors. The automobile supply chain is long and complex, with OEM and Tier 1 players relying on just-in-time inventory management practices. It takes about 6 months from chip production to car production, with several tiers of suppliers in between. Impacted by the COVID pandemic, vehicle manufacturers lowered their forecast for chips to suppliers, who shifted their demand to higher demand sectors such as consumer electronics. When demand rebounded months later, long lead times impacted supply. Having given this background, let us move on to the impact of the ongoing geopolitical tensions on semiconductors. US and European countries control design, while Asian countries dominate chip manufacturing. Fires at package substrate plant in Taiwan in October 2020 and February 21 aggravated the global capacity shortage for assembly, packaging, and testing devices. Widespread power failure following polar vortex in Texas and fire in Renaissance in Japan during early 21 exacerbated the global chip supply shortage, especially to the automotive market. While supplies were easing out in the last 1-2 months, the Russian-Ukraine conflict has the potential to constrain the supplies of neon and palladium, two critical components in the manufacturing of semiconductor chips. This could increase the cost of production. the West's sanctions against Russia could also lead to a disruption in trade and shortage of these metals. The next two sections talk about quarterly margins of auto component industry based on our sample of 49 large auto ancillaries and our financial forecast. The industry reported about 30% revenue growth YOY in 9 months FY22, partly aided by the low base of Q1 FY21. For Q3, it was a modest 5.4% growth, impacted by the high base of last year, supply chain issues, and lower two-wheeler demand. This is despite part of the growth coming in from commodity inflation. On the margin front, cost inflation and limited pass-through have had a bearing on margins. The coverage indicators, like we've always said, have remained comfortable for the industry because of low debt levels. ICRA expects the interest coverage for the sector to remain comfortable going forward as well, aided by healthy accruals and modest debt funding. We expect a healthy growth of 13 to 15% for the industry, aided by growth across segments and commodity inflation. Cost inflationary pressures will continue to impact margins in the next few quarters. If we exclude the Q1 FY21 impact, we expect margins for Q2 to Q4 of FY22 to be lower by 200 to 250 bps for auto components ex tires. Within these companies, those with significant exports will perform better. Debt indicators and liquidity are likely to remain comfortable for the sector, given the healthy accruals and modest debt funding requirements. Moving on to capex, our interaction with large auto component suppliers indicates a cautiously optimistic approach towards capex and investment plans for FY23. ICRA research expects auto component suppliers to gradually increase their capex and investment outlay in FY23, though most of these investments will largely be funded by internal accruals. The incremental investments will be primarily towards capability development, that is, new product additions in committed platforms, unlike investments towards capacity expansion witnessed in the past. There is some capex happening for development of advanced technological and electric vehicle components as well. The PLI scheme will also contribute to accelerating capex. Despite the healthy growth in FY22, production volumes across most automotive segments have remained below the FY19 levels, and hence adequate capacity will not be a constraint for the industry. Moving on to credit rating movements. ICRA's portfolio in auto ancillaries is diversified across rating categories, with bulk of the portfolio sitting in the investment grade of BBB and above. Downgrades trumped upgrades in FY20 and 21 after 6 years of largely because of the industry slowdown. This trend has reversed in FY22. The last part of the presentation talks about the potential impact of electric vehicles on auto component suppliers. Powertrain-related suppliers will witness loss of business, while there is a lot of opportunity for electronic component suppliers. Aftermarket revenues will also be lower due to lesser moving parts in EVs compared to ICE vehicles. That said, localization is a big opportunity for auto component suppliers. Only about 20% of the EV components are currently localized, and new opportunities would emerge in EV parts such as batteries, motors, controllers, and microprocessors. This is the last slide of the presentation, and this talks about the PLI scheme. The recently announced PLI scheme will increase localization, accelerate investments towards a local EV ecosystem, and has the potential to make India an export hub in the global supply chain. It aims to promote indigenous global supply chain of advanced automotive technology products, which is low compared to that globally. As Tier 1 scale up, Tier 2s will also benefit, resulting in multiplier effect and cost competitiveness. The scheme is also likely to capitalize on global economies de-risking the supply chain. The production and export of advanced automotive components will also help compensate potential loss of revenues from traditional components to an extent as overseas markets move into EVs in the future. With this, we conclude our presentation, and over to you, Sri Kumar.
Thank you, Vinita. Thanks everyone for dialing in for this webinar. We'll move to the question and answer session. We talked about the growth estimates in terms of the revenues is concerned for the industry, but this also comes on a good amount of a lower base of last year. And you had also indicated for Q3 the growth was for the sample was around 5 to 7%. Sir, I would like to take this opportunity to ask this question on the on-ground demand, both in terms of the domestic and the export front. What kind of momentum are you seeing on the demand front currently, and where do you see this demand for the next few quarters? If you can start on that front, we can take this question forward.
Yeah, good afternoon. So in terms of the demand, in the domestic market, I think the demand seems to be quite robust. We are seeing in the probably towards the end of 21, that is Q3 of FY 22, there was some lag because of the chip shortage. But now, especially in Q4, we are seeing that the demands are more robust. And what we are hearing from our customers is that this demand is going to continue to be robust in the next for FY 23 also. So domestic market, we are hoping that we will come back to peak levels and also probably grow about maybe 4 to 5% in FY 23. In terms of the export market, North America is back to good numbers. Even during the second, even I would say from Q3 of FY22, the numbers have been good and they continue to stay good. And we are hoping that they will have a strong year. Of course, a lot of dynamics are changing. Like for example, the effect of the Russian-Ukraine war, although they may not be directly impacted, the indirect effects, as was explained in the presentation, chip shortage, those are all things that are coming in, new things that are coming in. But without that, as we see, the North American market, we are expecting a good year in FY23. Europe relatively has been a little bit slower to come out of the chip shortage, especially Volkswagen and Ford in Europe are still having production loss. Even in the current quarter, they are having some production loss. And added to that, the current geopolitical situation may have a direct impact, especially where a lot of manufacturing is there in the Eastern European countries like Czechoslovakia, Poland are all big production base for most of the automakers. So we are in a wait and watch mode to see how it is going to impact but otherwise, Europe was heading towards a full recovery and a good FY23. So,
on the domestic front, sir, if you can dissect further, what factors are kind of going to support the demand in FY23? More specifically, if you can talk about the rural pockets, because there we see some headwinds.
Definitely, I think one is definitely the pent-up demand, because both significant part of FY21 and also a big portion of FY22, including the latest Omicron-related disruptions. I think there is some pent-up demand is there. And even the FY22 numbers would have been much better, but for the chip shortage issues. So I think overall, the market has a potential to definitely grow. And definitely the rural, I think out of all this, the COVID situation, the desire for people to move to personal vehicles, I think that has also definitely increased. And that will also drive towards, at least the PV sector, we expect a good increase. Similarly, even in the CV, because of the movement of goods and e-commerce, will definitely drive also the LCV and HCV also. We are expecting it to be good in FY23.
Talking about exports, sir, while you indicated that the driving factors are kind of strong in the North American market and also the Europe, there has been a gradual improvement as such. To what extent it is, or the Indian exporters are kind of benefited? Like, is the China plus one is the major reason why we are kind of seeing this growth, or is there better acceptance of our products in the overseas market that is also kind of complementing the kind of growth that you talk about in exports?
Yeah, see, the China plus one, there are two ways the China plus one impacts us. One is moving of existing business. There, it depends from commodity to commodity. Wherever there are commodities which are not safety critical, they move it immediately from source A to B could be possible. For other component manufacturers where they are more safety critical items, immediate shifting of existing business may not be possible. They may wait for the model year to get over. But what happened is that the China plus one impact almost started, I would say, about 2 or 3 years back. So a lot of new programs have been awarded to Indian companies, which are coming into effect in FY23 and FY24 launches should be more beneficial. The programs that have been awarded to Indian companies in the last 2 years, because the entire homologation time takes about a year or two for new programs to come into revenue mode. So I think that we should see a good jump in FY23 because of the actions taken by customers 2 years back. And in certain commodities where they can quickly move in and out, there may be immediate impact is also seen. So definitely China plus one is slowly but and steadily definitely giving more opportunities to the Indian auto component. Other than that, I think even in the US, there is definitely pent-up demand is there. I keep hearing that even now there, which is in the US generally, vehicles are generally don't have a waiting period, but I hear they have waiting period of 3 to 4 months in some cases. And we also see that, I also hear that the second-hand car market is at a very high level, which means that there is a pressure on getting availability of new vehicles drives the second-hand market also there. So there are indications that show that there's a lot of demand. And with the chip shortage more under control, I think the US market is bound to do well in the coming quarters.
Okay. Talking about this chip shortage issues, at the same time, we are also navigating this ongoing Russia-Ukraine conflict. Could we also say that the chip availability, whatever was actually going to Russia, will become available for other markets, including India and other rest of the world? That can indirectly propel the demand as well?
Probably in the short term, the Russian, the chip requirement of Russia may help. But in the long term, if chip production, if Russia is going to be a key supplier of RM to the chip manufacturing, so in the long term, probably that is going to come back and create a demand supply situation.
Okay.
So, as I was prior to this war, as I was seeing, my information or what I understood is that if you look at the calendar year 22 or the calendar year 21, I should say, there was a loss of about 12 to 13% in globally. About 12 to 13% was the loss of automobile manufacture due to chip shortage. So approximately the data was that the global volume is about 80 million. The production was about close to 70 million. So about close to about 13% was the loss due to chip. And the expectation for the current year, 22 calendar year again, was that this would get reduced by half. Maybe it'd be about 4-5% would be the effect of the chip shortage, and that would again get distributed to between certain countries based on the requirement. But now again with this with the new geopolitical issue, I have no idea how this is going to make the situation worse.
Right. From being a sustainable demand, when we talk about the overseas markets are concerned, what do you think that we have as an opportunity in the global space to become one of the major exporters as such, or especially with the fact that most of the developed nations are focusing on electric, autonomous and shared mobility kind of stuff. So what kind of opportunities or potentials do you think that we could have more long term on a sustainable basis?
I think one trend which definitely the auto component industry can make use of is that there is a more requirement or a need for value added parts. Go up the food value chain, make value added parts with assemblies, sub assemblies. That gives a good opportunity for auto component manufacturers to increase their top line. And also, when you do more value added work, there is also opportunity to improve your bottom line. So that's one way where we can take a bigger share. Second is, as you said, in EV, as more the Western countries are looking at more capex on EV, I believe that the transition is going to be in a phased manner. So I think probably in the next 5 years, or I would say the next until 2030, I think it's going to be in a phased manner. And after 2030, maybe depending upon the success and of the electrification, it may take a little bit steeper curve. So I think there is still about 7-8 years of active life for significant volume. So this percentage of EV may creep up to about maybe 20-30% by the time 20-30% by the time it comes to 2030. So still another 60 to 70% of ICE engine related parts, ICE vehicle parts still need to be catered globally. So if there are opportunities to tap that, where some capex may be required, I think still there is an opportunity to recover it over the next 8 to 10 years. So that may be an opportunity for companies to go into that. Although there's talk of that the electrification may be more faster, but I personally believe that at least until 2030, it's not going to be a drastic because a lot of people need to get their foot wet and then find out what are all the issues in terms of design, in terms of performance, in terms of the access, the charging, all the other things. So I think there is opportunity to invest and take money out if we have opportunities to invest in current technology parts.
Sure. And you spoke about the capex lined up, towards tapping these opportunities. To what extent do you think that the government schemes like PLIs, etc., would be tapped to support these kind of capex as such?
As regards PLI, from what I understand, the PLI seem to be more favorable to EV related components,
right?
And also wherever we are doing an import substitution,
right?
Wherever we are parts that are currently being imported and indigenized, make in India kind of a thing. So I'm to be honest, I am not aware. I mean, I'm not fully aware of this, and I don't. As I understand, there is not much benefits for exporters, whereas I think a lot of us are lobbying that critical components which are being exported should come under the PLI, and it is being heard by the government. But for promoting exports at this point, I do not see how PLI can be a significant impetus.
Okay. Sir, moving from the demand to the kind of immediate concerns that we see in the industry, or the key headwinds that we see in the industry. The first one is on the commodity prices. This has been a significant factor in terms of the earnings that we have seen of a lot of players in the recent quarters. What is your expectation in terms of the price movement going forward, especially with the uncertain, political tensions going around in the world? So, what would be your take on the commodity prices? To what extent it is likely to be passed on as well to the end consumers?
So again, because this geopolitical situation is so recent, I will probably answer first what I was expecting to happen before the war happened, and then what I feel is going to be the impact. So the aluminum, we'll start with the aluminum. Aluminum is at almost at an all-time high. I think I understand. As I recall, it's about LME is at about 3,800 levels. So our expectation prior to this war is that the aluminum would start coming down. It has already hit peak, and then it was we were expecting that in the next quarters that it will come down. But now with the war, it doesn't look so. It doesn't look like it's going to come down because Russia is a key supplier of aluminum, and so I think aluminum should, with the war, I think aluminum will continue to either stay or keep increasing further. Steel market was anyway still increasing, so because there was only indication that the further price increase would happen, and definitely with the war, again with Russia and Ukraine being significant source of steel production or steel supply, I think steel prices will also continue to increase, continue to grow. I think we are in for few more quarters of commodity increase.
Okay.
Yeah, definitely. I would say that it has really helped us to boost our top line without doing anything. So we will take that. But on the other hand, it is affecting our bottom line.
Okay.
Companies, companies like our company, we have a significant amount of back-to-back material compensation from our customers. But nevertheless, I think a continuous increasing trend is something that is not favorable for auto component companies. As also discussed, our cash flow comes into a lot of thing because the raw material are all almost upfront payment. There is less credit term for raw material, whereas our collections periods are much higher. So our inventory value of our inventory keeps going, becomes significantly higher. So that is definitely a concern when the raw material continuously keeps going up, and right now again we thought we were seeing some kind of leveling and coming down, but now with this war, not sure what's going to happen. It's definitely going to be challenging for a few more quarters.
Sure. What about the other key costs, sir? Like something like a freight, which was kind of another major concern last time because of the container shortage issues, and also the transit time was kind of getting longer.
Yes.
Is there a improvement in the story there? And also, from an industry standpoint, has this episode of container shortage made people realize the need for a geographical diversification and kind of wherein have their capacity spread across locations, things like that, or is it too early to kind of discuss?
Yeah, freight remains the cost remains still bad. Availability has improved. So I think we are able to get booking and containers relatively more easier than what it was. Okay. But the cost, it peaked and stayed. So that is a concern. As in the presentation, about 5 to 6 times it has increased. And that is especially companies who are into significant exports like our company. We are feeling a lot of pinch because of this, because of 2-3 reasons. One is that the freight cost is something that contractually we are not able to pass on the freight cost. So it takes a significant hit. The second is that the freight times also has increased. That still we don't have a consistent the freight time. What, for example, for North America, what used to take 6 to 7 weeks is now taking 9 to 10 weeks.
Okay.
So that's almost more than a 50% increase in shipping time. That means 50% more product on water. My inventory has increased by 50%. These are compounding, and then you compound it with the commodity being at the highest level. So your value of your, the total, it has a compounding effect basically.
Right.
You are having a higher commodity, so you are buying material at a higher price, and then you are holding it for a longer time, and then you are paying more for that freight. It's definitely a very difficult time for exporters with the freight being the shipment times being very high. Cost of shipment is still high. The only thing that has improved is probably availability and booking. That also was a problem. So now at least availability and booking seem to be eased out a little bit.
Okay.
The second question you asked was how has it changed the mindset of our customers?
Right.
Definitely, I think this will have an impact in the long term, especially in 2020 and 2021, during the peak of COVID, when we didn't get vessels and didn't have containers, we could not ship parts. There was significant air freight has happened, and smaller companies had to claim force majeure to our customers, and our customers had to chip in with a lot of cost to bear this part of this air cost.
Right.
So that is definitely on their mind. And with the continued shipping issues, I would definitely see that our customers would look at more of a local sourcing push, and is definitely expected. So that is what we were enjoying earlier with a very seamless logistics, and as long as we warehouse and supply, customers were quite happy. They did not bother where it was coming from. Now that situation is definitely more under purview. So I think this is definitely a risk that customers may prioritize closer or onshore manufacturing.
What with regard to commodity or be it freight is something outside anyone's view. It's more about external factors. But amidst these challenges, corporates can still kind of prune ways in terms of improving the efficiency or yield. So one such thing would be the energy cost, the way they find solutions as such. So what are the ways through which, the efficiency improvements are happening in the industry, and incrementally to what extent of cost savings that the industry can actually make in your views?
Yeah, I mean, I think even over the past few years, most of the industry has gone for more energy efficient equipment. That has been a very, very big drive to have more energy efficient equipment. So I think it is. I mean, you have your regular cost saving plans. We all drive continuous improvement. It starts from reducing your input material, and how to reduce your losses in terms of rejections. And in terms of energy, one way of compensating is also to invest on solar and wind, and then use that to offset some of the cost of the power. And in terms of oil and terms of oil rate increase and furnace oil, I mean, I guess there's only so much we can do, because as I told you, most companies have started going for energy efficient equipment, and companies that have not made that change, I think they need to invest on energy efficient equipment, so that we cannot just depend on equipment that guzzle energy. That is definitely a move that people can do.
Vinita, if I can come to you, what are we hearing from the market in terms of the ways and means through which component suppliers are trying to protect their margins at this point of time amidst all this inflation in commodity and freight issues? What are we hearing?
One thing on the raw material front is trying alternate suppliers, potential grade shifts of RM without compromising on quality, VAV, etc. There's also adequate stock that is getting maintained in order to capitalize on lower cost inventory. In the long run, what we see is automation will be a way forward. Energy efficient machines, like Mr. Ravishankar was mentioning, that's one way. Lower RM usage, changes in formula, increasing content per vehicle. These are certain things we're hearing from the market.
But I guess the RM change is also something that cannot be done very easily because of the warranty.
In the long run.
Yeah, I think that will also be a more of a long run. Source change, RM change are all, especially it depends on the commodity. If you're in a less severe commodity, maybe the changes can happen easier. But wherever you are making functional or safety critical components, the validation cost, validation time, and approval times are all in years. So I guess these are not short term. Probably may not be short term opportunities.
Sure. So from a liquidity point of view, be it the working capital cycle or from a cash flow availability point of view, is the scenario still manageable because of the earnings pressure, or do you think that already the stress has been visible and we are only going to experience much further tightening on the working capital cycle going forward?
I think the right now, as I told you, the shipping. I mean, I guess already I think we have experienced. I don't think it is going to get any worse, because what happened during COVID, in terms of the shipping time, shipping cost, all that. I hope it is not going to get any worse, because already it's really in a very bad situation. I think there's only one way that it can improve, and we are hoping that shipping times, even if they cut by 2 weeks, where there's a lot of scope, that will only help us to ease the inventory and the working capital cycle. But in those angles, we think that we have seen the bottom, and things can only get better going on. But commodity is definitely a concern, especially with the war. If the commodity prices keep increasing and thereby putting more pressure on the cash flow cycle, then that can become challenging. So especially this is more for exporters, because the lead time being more. So there, of course, one point is that the one good thing is that the exporters are given a subvention on the working capital. That policy, it has not been from September 2021. That subvention has been discontinued, or no, I would say it has not been reinstated. So we are hoping that the government will reinstate that subvention, so that exporters can at least get money at a lower rate. So there is a 3% subvention for exporters to get capital for working capital. So that has not been it has not been discontinued, but at the same time it has not been continued after September 21. So we have taken this up through various EXIM channels, and we are getting a positive feedback from the government saying that this will be reinstated. So that will really help exporters to at least get the money at a lower cost, so that we can fund this additional inventory.
Amidst these challenges, what would be your opinion on the capex spend in the industry, sir? Do we see the industry kind of taking a step back and possibly postponing some of the announced capex plans, or we since the demand outlook is likely to remain stable, would we see continuance of this capex and the fact that some of the like you rightly mentioned, the PLIs on the electric vehicles, they are they good enough to kind of attract these commit these capex? What would be your view on the capex part?
I think capex will continue at a stable level because I think again last 2 years for most companies the growth was not significant. So a lot of people had invested for this growth, and but definitely all companies for their FY23 and beyond need to augment more capex is required because opportunity is again bouncing back. Even without EV, even for the regular increased export and increased domestic market, I think steady flow capex will be stable. I think it will not. The capex should continue to be stable or marginally be better. That is what I feel. And when EV technology comes, definitely a dedicated specific capital has to be put in place when people start developing new products to cater to the EV market. I think that will give a bigger impetus to the capital market as and when that happens. But even without the EV, I feel that there should be the capex market should be steady and grow in a small way.
So where do you see this money being spent towards? Are they towards expansion of the capacities, or because of the fact that the need for localization has actually increased? So towards development of the vendor base, are they likely to commit investments? Or the fact that the demand is going to be stable, the debottlenecking kind of capex. Where do you see the investments headed towards?
I think, as you said, some amount of investment will be definitely towards replacement. I mean, getting the new business, Make in India, will create a lot of new investment. Similarly, the China Plus One business that was awarded, as I told, this has been happening over the past 3 years, where a lot of customers have been awarded business that are going to begin in 22, 23. And for that, investment needs to happen in the export front also. And similarly, for the pent-up demand, last 2 years, people have not invested. They have been trying to manage with the existing capacity, trying to be very tight on capacity and managing. So now I think people will definitely try to keep additional capacity and generally automotive industry to a certain extent, we keep some open capacity so that when opportunity comes, we can quickly react and take it. Last 2 years, people were not keeping this kind of open capacity. They were trying to use all the open capacity to manage the existing business and existing growth because of the uncertainty in the market. So I think again, customers, now that the situation is better and the prospects look better, I think the auto suppliers will again invest and keep some open elbow room for additional business. So that should also drive capex. Okay. And any challenges that you see on the funding part for this capex from the financing environment? I'm not able to comment on that because I'm not not had any specific experience on that. Sure. And on the electrification, sir, you did say that the road towards EVs in India is likely to be a gradual process. Like you did indicate that in your initial remarks that you expect it to be somewhere 2030 is when you expect a meaningful transformation towards the EVs. But from a preparedness point of view, what would be your views on the domestic component suppliers, how they are kind of prepared? Are you seeing the need for kind of committing on investments in the technological changes as such? Your thoughts on the EVs? Yeah, a few points in the EV. I think if you look at preparedness, lightweighting will be a very, very important part because the battery, the amount of battery or the battery weight is going to be directly proportional to lightweighting. Lightweighting means more use of aluminum. Use of aluminum in India in automotive is very less. compared to either North America or Europe. So I think opportunities for aluminum, more aluminum components. Aluminum is price sensitive, so it has been avoided in India because of the the price sensitivity of the market. But when you go to EV, we may not have a choice. I think significant portion may have to move to aluminum. So I think that is a significant opportunity and area where a lot of capex R&D has to go in. Similarly, the battery, as in the presentation, battery technology, motors, and also charging and other accessories like charging stations, charging related equipments. So those are all again areas where it's an opportunity for people to migrate, especially people who are already in either engine or fuel management or powertrain related, who are concentrating in this area. This may be an opportunity for them to diversify so that as one comes down, where revenue comes down in ICE, the EV can augment that. So I think those are the areas where I see the opportunity.
Okay.